Welcome back, everyone, to Lem's Cryptoverse. Today, I'm going to talk to you about something I learned in school and just something I learned in religion class, I should say. I learned about limbo. You remember that? The place between heaven and hell. And how about this? In management class at university, I learned something called do nothing. Basically, there are a few types of strategies when you have a major management decision or even minor. But really, we're talking major here. Like, let's say it's a crisis. You can do something very drastic about it. You could do something somewhat drastic. You could have a meeting with lots of people and compromise and have a mushy answer. Or you can do nothing. And my management professor always mentioned, he stressed, as a matter of fact, that doing nothing was a very important thing to do, a very important action. So today, I think that it's springtime and capital markets seem to be going up and down and really doing nothing. And this is not just stocks or bonds and crypto. It's like everything. So I think at this time, what we should do is put our heads down and study some good blockchain projects, but they take a long time to understand. And if you're not into blockchain or crypto, maybe you can look at that, especially if you are against crypto. I think that you need to spend lots of time to understand it before it clicks, because if you don't, like me, initially I didn't understand it and I thought it had no intrinsic value, that it was worthless. It just didn't make sense to me. So if you don't have the time to put in, you really can't understand it. That's why this is a good time to do that. The second thing I wanted to tell you is it's spring and it's also a good time to go outside, go hiking, or put some plants out there, plant those tulips or whatever you like to do. But don't spend time trading. It's just going to be a waste. And I'm going to show you some examples of that right now. Examples of why I think all types of markets are in this intermediate zone. And I think my guess is that we're waiting. And when I say me, I mean capital markets. I mean the economy is waiting for the economy to move from a very strong one to possibly, most probably, I would say, a recession. And so you're going to see that in all kinds of data. So I'm just going to give you a potpourri of this data, all sorts of data. So let me minimize myself. So the first one is the CNN Fear Greed Index. And speaking of limbo, we're literally at 50, at the exact middle. So if you recall, this is a contrarian indicator. So this indicator, and this is a historical viewpoint going back to about a year ago. So this is, like I said, it's a contrarian indicator. So it's bullish when everyone's fearful, and vice versa. It's bearish when everyone's bullish, but we're in the middle now. So again, this is limbo period. So you shouldn't do anything based on this index. Let's go to another one. So what are stocks doing? Well, I like to look at the S&P. I look at all the indices. Russell 2000 small cap index, NASDAQ, Dow Jones. Of course, it's important to look at all the indices, but it's also important to look at, for demonstration purpose, at one index. So I like to look at the S&P. If you look here, we're almost at the major overhead resistance where the market's going to go down again. Now, some investors say this is bullish because we're breaking out above the averages. I have a 50-day moving average here. You probably can't see it. Maybe I can make this a little larger. Now you could see here that we broke out of this 50-day moving average in purple. So investors, some of them are saying this is bullish. My framework is that we've been in a long bear market. So this is not the quick V-shaped recovery that we had in 2020. This is going to be a typical bear market, which is going to be at least a year. So if you think in that terms, that term of framework, then we're in a bear market, and what you see in terms of the breakout of the 50-day moving average means nothing. It just means that we're heading towards resistance, and that's this red line here. And I also had it angled. I just changed it now, but an angle that it had, here it is, this trend line here. I was thinking that we either broke it and we're going to go down again, or we didn't break it, it's like this, and we're going to go down. So I'm not bullish at all. But either way, I think you would agree with me that we're in some kind of limbo zone. How about Bitcoin? I think Bitcoin is the same thing. Bitcoin's about 28,000. It seems like we've been like that forever between, well, I could show it to you here. I think 27,000. Just move myself here. Yeah, we've been between 28,000 for a long time. Looks like a month. But my point is, we went up a lot starting in end of last year. But what I want to point out, you can see my pointers here, is that we went up dramatically during the SVB, Silicon Bank, and all regional banking crisis that occurred a few weeks ago. That's when we went up, because the 2-year yield, if we remember, had one of its largest drops in history, going back to drops that occurred during the 1997 crisis, the dot-com crisis, and the 2008 great financial crisis. So that's why we went up, because Bitcoin was sensing that there was going to be another crisis and another debasement of the US dollar and more quantitative easing. So I think that's not going to happen right now, because the Treasury and the Federal Reserve are working together to at least put a short-term bandage on the banking crisis. Doesn't mean there's not going to be a crisis. It just means what I said in my earlier video on the Silicon Bank crisis. In that video, I said that this is the beginning of a crisis. I said in that video that there's a short-term crisis of banking deposits, but the real crisis is going to be when we get a credit crisis and an office real estate crisis. And that's going to occur later on in the year. Maybe, we're in April, maybe by July, August, September, that's when we're going to have, I think, a major crisis. So, these things take time. Remember, during the bankruptcy of New Century, the subprime mortgage company, that bankruptcy of March of 2007, the Dow Jones went on to have a new high back in October of 2007. So between the beginning of the crisis in March of 2007 and October, the Dow Jones hit a new high. So just be aware of that. So next chart. Again, this is the Bitcoin and crypto fear greed index. This is like their version of the CNN fear greed index. And you could see that we're in limbo here. Actually, we're kind of high. If you look at a long-term, let's go to max. If you look at a long-term chart, we're not the high here where everyone's greedy in December 2020, but we're not low here. Actually, I think we're more. If you look at let's go to a 1-year chart. This index actually, to me, is more on the high side, which means it could go down short term. So this means that Bitcoin and crypto could go down short term, because right now we're at greed, but we're not at extreme greed. So again, this is why I'm saying we're at limbo, at an intermediate term. So let's go to the next one. You might be saying, why am I including Bitcoin average mining cost, which is what I have here? This is, by the way, one of the best websites for getting average mining cost. Glassnode likes to use a correlation quantitative strategy, and some other ones Other people like to actually look at raw costs from actual individual miners. So you get all kinds of data. I like to use this because this has been somewhat good, somewhat consistent. And you could see it's going up again. So my point is, you're not going to get a major bottom in Bitcoin prices when you've got the average mining cost equal to the Bitcoin cost. It just doesn't happen. So just keep that in mind. You could take your time and look at this, but I really think we need to see a big crisis from Bitcoin miners before we hit bottom. Yes, we had a small crisis. We had some Bitcoin miners going bankrupt. I don't think we had enough pain. That's just my feeling. So let's go to the next one. This is from Glassnode. Now, this is actually a positive. So what this is showing is two things at the same time. It's showing the price of Bitcoin, and on top of that, it's showing a color scheme. That color scheme is showing distribution or accumulation. So you usually get these top whales distributing coins when we have a Bitcoin peak, and you see that here. You saw that in July 21, and when it's yellow, that's in orange, that's distribution. When it's purple and bluish, that's accumulation. So the good news is, even though we had distribution, you can see that here, and this is a circle D. The good news is, as Bitcoin has been going up, we've seen some accumulation. The only thing I would caution is that if you go down here, this is showing the cohort accumulation distribution. So when it's red up here, that's showing that institutions that own greater than 10,000 Bitcoin are distributing. So that's not good. But if you go below that, and even some shrimps and smaller holders, you could see they're accumulating. So overall, I have to say it is bullish. But just be careful, because I don't think we're at a very good bullish area, because you want to see all blue. You want to see blue, meaning we're accumulating from all cohorts, and we're not seeing that. We saw that here back in 2022, and we also saw it back here, back in the bottom of July 22. And I would say, I don't have the data back here, but I would say if you go back to the previous Bitcoin bottoms, you would see there was a lot of blue. So again, yes, this looks kind of bullish, but to me, I think we need to be more bullish. We need to see a longer period where there's accumulation by large whales. And that's why I'm showing you this chart right here. And this is the Puell multiple. I'm sure most of you know the Puell multiple. So when it goes down in green, that's a good thing. And this is, for those who don't know it, I'll read you the definition. It's a ratio of the value of coins issued to its yearly average. So basically, this is the coins issued by miners, basically. So basically, you want it very low, to 0.4 or lower. So we did hit so some people arguing that Bitcoin's already in bull market because we hit that low. And I'm being stricter. I think we should hit this low point here, about 0.4, and we should stay there for a while. So we haven't done that, and now we're rebounding. I actually think it's pretty high, the Puell multiple. So miners are not suffering. That's what it's really saying. And here, this is options. Let's see the title here. Yeah, this is options, and this is open interest of Bitcoin options. And we're already going. So the bottom was here. Some would argue this is bullish because options open interest hit a low, and now we're going up again. But I would say again that we didn't stay low enough. Here's something that no one's talking about. It's apathy. For a bear market to be complete, we need investors to be apathetic, and they could only get apathetic if stocks and options and futures and Bitcoin and whatever, everything is at a low point like this, and it stays there. It goes low and it stays. We're not seeing this. We're seeing more of a short-term bottom, and now it looks like we're even going towards a short-term top because there's been a lot of people buying call options now on Bitcoin and ETH. As a matter of fact, if you want to see it, I could show it to you. It's right down here. And you can see implied volatility is too low. Again, we're in limbo at that intermediate period where volatility is neither low or high on options. And I was getting to the put to call ratio, and you could see that we're very low. One thing I would caution that I don't trust this ETH number. It just spiked up there. That doesn't make sense. It's still low. It just doesn't make sense that it spiked. I think I know why it did that. That put to call ratio on ETH spiked. That's related to the Shanghai upgrade on the Ethereum network, whereby Ethereum is finally letting those coins that were staked for months and months, they're going to be released as soon as April 11th or April 15th, something like that. The date keeps changing. So what people are doing here is they're starting to buy some put options in ETH to hedge that, because people are worried, investors are worried that when all that ETH becomes unstaked, it's going to be dumped on the market. So let's go to the next chart. So we talked about that we're an intermediate point, and there is no more crisis, right? We have the banking crisis that seems to be eliminated, but let's look forward. Where could the crisis come from? It could come from many places. I think the key word for crises is going to be private. It's going to be something that has to do with private equity, private debt, venture capital, or crypto. Venture capital that's focused on crypto. We already saw those blow up. So I think it's going to be from unfunded liabilities. And let me show you what I'm talking about. This is pensions. And if you look here, this is a chart of total unfunded liabilities for state and local pensions. And you can notice the liabilities just keep going up. They go up, 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 up. But the assets are not they're not keeping up with the liabilities. Now, they did go up sharply because we saw the stock market went up sharply, but now they're going down again. But here's a problem. Even though they've gone down quite a bit, and we're at $4.9 trillion versus 6.4 trillion in assets. So that's 6.4 trillion in assets versus 4.9 trillion in unfunded liabilities. The big problem here is that the 60-40 asset allocation for pensions, especially large, so-called sophisticated pensions, that 60-40 allocation is no longer being used. And you're seeing the same thing here with endowments. And pensions, or what they're doing now is they have been reducing their asset allocation to public equities, and they've been buying more venture capital, real estate, and they've been buying a lot of private equity and private credit. And remember, these have not been marked down. These take up to 1 year to be marked down. I'm speaking to you slowly so you could just get it in, so I could stress to you how important this is. The last time we saw something not being marked down was, you guessed it, during the GFC, the Great Financial Crisis, when stocks went down initially and bonds, but collateralized debt obligations did not get marked down. And that's the problem here. Nothing's getting marked down yet. We only saw the beginning of that when a few weeks ago, Tiger Management marked down some of their private equity, private debt. They marked it down by over 30%. So that, my friends, is what's going to happen. Imagine 30% being chopped off right here, the unfunded assets, and that's not even equity. That's just the private stuff being marked down. So if that gets marked down, that's going to be a big decline in the big widening of assets versus liability for pensions. So that's a pretty scary thought. And here they just these people from Lycan, they just focus on the Federal Reserve balance sheet, that there was a response here, meaning that we had QT and now we've got QE. I go, since we're on this chart, let me give you my viewpoint. I don't think we're really in QE again, even though it superficially it looks like quantitative easing. It looks like quantitative easing because the balance sheet's going up and the Federal Reserve discount windows is loaning, I think it's like $2 trillion to banks. But the problem is banks are tightening their lending standards. They're not loaning money. So no matter how much money the Federal Reserve and the Treasury give to banks, banks are not going to do anything about it. Banks are really scared. So that's not going to cause an increase in the money supply or velocity of money. So that's going to be equivalent to the Fed raising rates. Even if the Fed doesn't raise rates, it's going to be equivalent to the Fed raising rates and a tightening of money supply and a tightening of the Federal Reserve in terms of being hawkish. So let's go to the next slide. This is unemployment rate. As you can see, the Fed still has work to do because the unemployment rate is around, I think it's 3.7%. It's way, way too low. At this point in time, the Fed did all the easy work. The easy work was getting rid of all that goods inflation. But now we've got the sticky inflation. This is what they call, I can't remember what the word they use, but this is the services economy. And that services economy and wages is what's keeping inflation high. So it's going to be very difficult for the Fed to get rid of that inflation unless they make the unemployment rate go high, which means the economy has to go either into recession or slow down. I think it's going to be very difficult to what I think Lawrence Summers once said in the 90s. It's going to be difficult to have what he said, the Goldilocks economy. It's going to be difficult to have a soft landing. And lastly, I want to introduce this data I just found from Trading Economics. I usually use the San Francisco, St. Louis Fed. They call that the Fred data. That has very good data on the U.S. economy. But if you want a whole table of everything, including other countries, Trading Economics is a great website to use. And here you can see they have a heat map. It's kind of hard to see the colors unless you click on something. So let's click on inflation rate. And you can see it's all red. And if you click on it the other way, it's kind of bluish. Or if you click on interest rates, it's blue for Zimbabwe. They have 150% interest rate. So it's pretty good if you want to compare countries transversely. So you can see here, we still have good GDP growth, but that's probably going to slow. We have 5% inflation rate, but we have a 5% interest rate, which is below the inflation rate of 6%. And that's a problem, my friends, that the interest rate is below, meaning the Fed funds rate is below the inflation rate. We didn't see that back in the late 70s and the early 80s where we had an interest rate, thanks to Volcker, we had an interest rate that was higher than inflation rate. And that's how we were able to bring down inflation. And you can see here the jobless rate, I said 3.7, it's actually 3.6. And the debt to GDP, don't get mixed up with this. It's saying 129%. This is only, maybe I should click on it to show you what it means. It's only government debt to GDP. This is not total debt. Total debt to GDP, I'm tongue-tied there, is almost 4 times. Again, total debt to GDP, including corporate debt, is almost 4 times. So that, my friends, is at the point of no return. So eventually, after we get this recession, yes, the Fed is going to have to pivot, and the the Federal Reserve is going to debase the US currency once again because we've reached the tipping point where it looks like the Congress and the Federal Reserve and the Treasury basically doesn't have the political will, or it's just too late to fix this problem that we have of a weak dollar and currency debasement and a high deficit. And remember, the Social Security and the deficit, everything's too high. I'm trying to think of the term, but basically the toothpaste, as Warren Buffett used to say, the toothpaste is out of the tube. You can't put it back. And that's what we're seeing with the high debt to GDP and the budget deficit. It's just it's out, and we can't put it back in the bottle. So that's it, my friends. I just to put it all together, we're at an intermediate point called Limbo, where the stock market and everything else looks like it's gone up, but it's going to hit a lot of pressure, and it's probably nowhere to go going forward but down. The same thing with the economy. There's nowhere to go but down, because remember what Jerome Powell said. He's going to keep raising the Fed funds rate until he gets to about 2%. I'm thinking 3%, but whatever, 2 to 3% on inflation. Well, thank you all for listening, my friends. And don't forget to like us and subscribe to us. Bye-bye.